While it might seem like this is a very difficult market to navigate and we have no idea what's going on, it seems like the market's all over the place, being very volatile, and we can come up with those kinds of phrases to throw on it. It's actually quite clear what the market's doing, and there's plenty of clarity, in my opinion. The market peaked and rallied when Powell spoke at the FOMC meeting. The market was up that day. We obviously, before that, loaded up on short bets, thought the market was going to go down, thought that meeting was going to be hawkish. We recorded our video after that meeting, thought it was hawkish as we were getting our face ripped off, and the market peaked just hours after that. It has since come down, has continued to make lower highs and lower lows, and is in very much pullback mode. We have seen very much a pullback. We've seen a sell-off in bonds that has not yet fully translated to stocks. We have seen some move, but we're still, roughly right around where we were before Powell. In my opinion, we should be much lower. And we're beginning to see cracks in the market. Let's not forget, this market has had some tremendous forces. We saw GME, above GME, so above GameStop peak levels of retail participation. We have crazy amounts of flows in terms of 0-day to expiry options. It is speculation mode. And that contributes to liquidity. All of this contributes to liquidity. And when you have high amounts of liquidity, it's going to be hard for stocks to sell off. We know not a lot of people are buying bonds. Bonds have much thinner liquidity than stocks at this moment, it seems. Although the market is bigger, the liquidity picture is a little drier. It's not the same as it is with stocks. The liquidity is just tremendous in stocks. So when you have a massive pool of liquidity, it's hard to really get levels down. However, we're seeing that today. We're seeing Bullard talk about 50 bips affect the market. And this isn't really a fundamental thing. If you have been doing your homework on the Fed, which you may or may not have been doing, that's fine. It's, a lot of things the Fed says, a lot of members. But I will tell you, Bullard was talking about 50 bips before the last meeting. He was talking about 50 bips before the last meeting. So the fact that now today he's saying, oh, I supported 50 bips to the last meeting, it really isn't anything new. But the market needs to correct. It just does. And it's that, I guess that's the catalyst. He's saying 50 bips at the next meeting. He's not ruling that off the table. I mean, we got hotter than expected CPI. We got tremendously hot producer PPI today. The market recovered on that for no reason. It's just a crazy picture out there. And it's time for reality to set back in. I mean, Bitcoin's up over 10% this week so far. It's a tremendous environment. It just truly is. And it is hard to predict. However, we believe the fundamental forces are going a certain way, and that is negatively, and we can use that to our advantage. Ultimately, that's what it's about. Fundamentals. As I said, the market incorrectly interpreted Powell, and I say incorrectly because every Fed member has been hawkish since. We're seeing how people are responding to Bullard. We've seen what the bond market has done since Powell. Yields went down initially after Powell, 10-year down to 3.3%, and now we're pushing 3.9%. That is almost 20% move in yields. That's a big move in the 10-year. So things, the bond market is not filled with high liquidity, speculative traders, that kind of thing. The bond market is serious people who are trying to, who literally only take in, when you're dealing with the risk-free rate of return, you only deal with fundamentals. The rate of inflation, the Fed funds rate, what's risk look like? You only deal in that. And bonds have had the kind of move they've had. Obviously, we should take some keys from that and listen to that and not ignore that. It's not always right. Obviously, 3.3%, yields came down after Powell. Obviously, that was not the move. I'm not trying to say bonds are always, this magic guru and we just have to follow bonds. That's not what I'm saying. What I'm saying is there's been a big divergence between stocks and bonds. We know stocks have certain forces, and particularly right now have crazy forces more so than usual. We know bonds have certain other forces enact a certain way and then value certain things a different way, and there's a divergence. And if you look throughout this year, every time there's been that divergence, it's signaled the top of a bear market rally, and it looks like the past couple weeks has very much been what the top of a bear market rally looks like. We saw a rally after Powell that shouldn't have happened, and that was the peak. And since then, we've just been slowly drifting. There's been those liquidity forces, there's been those retail forces, there's been those 0 day to expiry forces, which add liquidity to the market, but they're slowly draining, okay? And now we might be ready to correct. And that's not an unusual thing to do. It's a very normal thing to do. We've seen it many times throughout the year. Look, earnings are not good. There's no reason to buy stocks. There's no money to be made, in my opinion, right now in stocks, because in order to make money in a stock, you need earnings to grow. You need something, and earnings are not growing. Apple contracted. Amazon didn't make earnings last year. They lost money. Google not doing as well. Microsoft talking about slower growth in key components of the business and disappointing in those key components of the business. So that's the picture here. It's not the best. Simple as that. Prices are very expensive. In my opinion, it's an opportunity to short. We've been doing that. We've been getting skinned alive a little bit, but hopefully we're going to make it all back and then some, because that's what the market and the fundamentals ultimately point to being the case. Maybe not the market points to that, at least not yet. You know, it is a little too early to celebrate here. But the fundamentals are pointing a certain way. They always win. They always win. You know, it's not that straightforward. The market can remain irrational longer than you can remain solvent. So please be smart about your risk taking on the downside as well. But fundamentals always win. Simple as that. If you've been on this channel long enough, if you've seen us, if you've been with us through thick and thin, you know this, because it seems like we get our face ripped off and then we make a lot of money. So that's the story of how things go. That's just part of participating in the market. It can be a very difficult and challenging thing. It can be a very painful thing. You have to have a full and complete understanding of your personal finances. You need to have enough cash to pay your bills. If you don't do that, you can make some money, but you can also deal with a lot of stress and a lot of pain, and it's not worth it. It is better to be comfortable, and that allows you to be comfortable through volatility, and you ultimately need that. You need to be comfortable through volatility. So that's today's video, and until next time, peace out.